Okay, we are recording. Hi there, everybody. I'm doing this recorded lecture for Chapter 10 of our Principles of Accounting textbook. And so as we discussed in class, Chapter 10, we're going to be talking about these cash discounts. And depending on what side of the transaction we're on, whether it's the sales discount or purchase discount, and so we're going to look at examples of those. We're also going to talk about, because overall this chapter is about cash receipts and cash payments, we're also going to talk about the cash receipts journal and look at an example of that, and the cash payments journal, look at an example of that. So I am going to share my screen with you and get the PowerPoint pulled up. So let's see, share screen. Okay. So hopefully, everybody can see that PowerPoint now. And so again, as we discussed in class, Chapter 10, we're talking about cash receipts and cash payments. Another way to say this would be cash inflows, right? Cash receipts, money we're receiving, cash that's inflowing to us, yeah. And then cash payments or outflows, right? Money that's flowing out, that we're paying out, right? So that's what we're looking at in Chapter 10. So we've been getting practice with in Chapter 9, we've been getting practice with the journal entries for perpetual inventory, periodic inventory, merchandising companies. And so now we're looking at those entries for, again, either the receipt of cash. If we were the seller, then we're expecting to receive the cash, or the payment of cash if we were the buyer. And again, on each one of these, we have to look at, what, if any, discount we're given, whether it's a sales discount or a purchase discount. So that's what we're looking at. Some of the learning objectives here in Chapter 10: determine cash discounts according to credit terms. In the general journal, record sales transactions involving cash receipts and cash discounts. And again, the credit terms, just so we remember, the credit terms are that, or those that we saw, the 2/10 N/30, right? I'm trying to get my pen out of here, right? So credit terms 2/10 or N/30, right? That means that 2% off if paid within 10 days, or the net amount is due in 30, right? So in the general journal, record purchase transactions involving cash payments and cash discounts. As we're going to see, when we are looking at sales transactions, then we call it sales discount, right? When we're looking at purchase transactions, then we call it purchase discount, right? If we're periodic inventory, purchase discount. Otherwise, perpetual inventory, it decreases merchandise inventory. So anyway, we're going to look at examples of that. We're going to record transactions involving trade discounts. In the cash receipts journal, record transactions for a merchandising business, and then post those transactions from the cash receipts journal to the general ledger and accounts receivable ledger. And then in the cash payments journal, record transactions for a merchandising business and post from a cash payments journal to a general ledger and an accounts payable ledger. All right, so credit terms. Again, we've talked about credit terms before. We've discussed it and gotten a little bit of practice with it in class together. So the credit period is the amount of time before the buyer is required to make full payment. So if we're saying N/30, then the credit period is 30 days, right? Or if we're saying N/60, then the credit period is 60 days, right? So the amount of time the seller allows the buyer before full payment has to be made, right? So usually these cash discounts are specified on the invoice or in the contract, whether it's 1/15, remember 1/15, 1% off if paid within 15 days, right? Or 2/10, 2% off if paid in 10 days, right? Okay, and so that cash discount represents the amount that a customer can deduct if a bill is paid within a specified time. Discount is based on the total amount of the invoice after any returns and allowances and freight charges on the invoice have been deducted. So again, we don't give a discount on any returns or allowances. Obviously, we don't give a discount on freight charges either. Okay, so here's an example of a sales transaction, and we've seen this one before on August 1st. Whitewater Raft Supply sold merchandise on account to Mesa River Raft Company. Invoice number 9384, $1,933.50, terms 2/10N/30. Again, that journal entry to record the sale we've seen before. We're debiting accounts receivable, we're crediting sales revenue. In this case, sales, I like to call it sales revenue, right? So we know that's our revenue account. All right. And now here it's showing, okay, so we had let me back up a second. So we had terms of 2/10. We sold merchandise to Mesa River Raft Company. We're Whitewater Raft Supply. So we sold merchandise to Mesa River Raft Company, 2/10. So 2% off within 10 days, right? 2% off if paid within 10 days. And so now we look here at the next slide and it shows us when they pay within that discount period, what that transaction looks like. So on August 10th, we received a check from Mesa River Raft Company for $1,894.83 in payment of invoice 9384 less the cash discount of $38.67. So just like we did, in class, and remember there's kind of more than one way to do it. We have to subtract that 2%. And so I think the easiest way to do it, and again, we got practice with it this way in class, is say 1933.50 times 0.98. In other words, times 98%, right? Because if we get 2% off, or in this case, if we're giving a discount of 2%, that means we're only going to collect 98% of that invoice, right? And so if we take that 1,933.50 times 0.98, again, that gives us that 1894.83. That gives us the amount of payment that the customer is actually going to make, right? And so here they're showing it in the two-step process. Basically, step one, they're calculating the 2%. Step two, they're subtracting the 2%, right? So that's the two-step way. This other way, by multiplying it by 0.98, it's only one step, essentially. But I guess you still got to figure out the difference between the two. So anyway, whichever way makes the most sense to you. But so we're going to debit cash 1894 and 83 cents. We're going to debit sales discounts 38.67, and then credit accounts receivable for that customer 1933.50. Okay, sales return. So on September 1, Whitewater Raft Supply sold merchandise on account to Rugged River Company, invoice 9391, 3,614. Terms 2/10N/30. Again, we've seen this entry before. Debit to accounts receivable, credit to sales revenue, right? Now they're returning some merchandise. And again, we've seen this one before. On September 5th, Rugged River Company returned 254 worth of the merchandise. Whitewater Raft Supply issued credit memo 1069 and recorded the transaction. So debit sales returns and allowances, right? That's what we see here. Debit to sales returns and allowances, credit to accounts receivable. So we've done that one several times together before. Okay, and so now the customer's making the payment. And so just what it's showing us here is that, remember, the original invoice was 3614, okay? And then they returned $254 worth of merchandise. So basically we're looking at, if we put it the other way, 3614 minus 254. Oh wow, let's see if I could do this without messing it up. Let's see. 3360 is actually the amount that they owe us then, right? Because they originally purchased 3614 and then they returned $254 worth, right? And so they only owed us 3,316, or 3,360, excuse me. So then if we take 3,360 times 0.98, because again, we're given a 2% discount, that's where we get that 3292.80. Right? Okay. So anyway, debit to cash for the amount of the payment, right? Less that 2% discount. Debit to sales discounts for that 2% discount. Credit to accounts receivable for the entire amount owed, or the entire amount of the invoice. Okay, so here's just showing us an example. Again, we've talked about this before. I've written this on the board before. You know, basically we're going to take our total sales, right? We take our total sales and then we subtract any sales returns or allowances or sales discounts. So we're going to subtract 2,920. So our net sales, 254,260. Net sales, right? That's our net sales. So that's ends up, and this is our income statement, right? So that's what ends up happening on the income statement, where before we just looked at, okay, revenue was X amount of dollars, and that's what we use for our number. Now it's just showing us that when there are sales returns and allowances and sales discounts involved, what we do is we start with our net sales, or excuse me, we start with our gross sales, and then we subtract any sales returns and allowances, any sales discounts, and that gets us our net sales, right? Okay. And then something else, and we're going to get more practice with this, preparing this income statement this way in chapter 11 and chapter 12, but then we think about our cost of goods sold section. And so with cost of goods sold, we're looking at, okay, what was inventory at the beginning of the year plus what we purchased basically, right? So we started with our beginning inventory plus purchases. And then we want to subtract any purchase returns or allowances, any purchase discounts. That gets us to net purchases, right? We're adding freight in. And then so we've got the delivered cost of purchases, right? So we took our 67,000 plus 87,840, right? Minus 2280. So this was a minus. That gave us the 85,560. And then we added freight in. And that gave us that delivered cost of purchases. And so we take our beginning inventory, merchandise inventory, plus delivered cost of purchases, and that gives us our cost of goods available for sale. Cost of goods available for sale. And what they're not showing us on here is that after we have cost of goods available for sale, if we subtract our ending inventory, is that equals our cost of goods sold, right? So cost of goods available for sale minus ending inventory gives us cost of goods sold. All right, purchase discounts. We got some practice with these again in class. We'll get some more practice with them in class together. Not too bad. Now it's just from the opposite side of the transaction. So before we were the seller, and so we were offering a sales discount. We were debiting the sales discount, right? But now we're approaching it from the other side of the transaction, from the buyer's perspective or the purchaser's perspective. And so we're going to have a purchase discount and we're going to credit the purchase discount, just like we saw in class together. So the purchases discounts relate to the buyer's purchase of merchandise. Under the periodic inventory system, purchase discounts is a contra account, which just means it's opposite or reduces the purchases account, right? It reduces the purchases account. So just like we saw back here, when we have purchase discounts, less purchase discounts. So when we have purchase discounts, that reduces purchases, right? Because we take 87,840 minus 2280. So it's a contra account in the sense that, again, it's opposite to it, or it reduces the purchases account. So just like it shows here, treated as a deduction from purchases on the buyer's income statement. So we're going to look at some examples of some purchase discount transactions. So this one says, on August 2nd, Whitewater Raft Supply bought merchandise on account from Pataponia Inc. Invoice 2706, $1,710, terms 2/10 N/30, dated July 31st, FOB San Francisco. Freight prepaid and added to their invoice $85.50. So again, we've seen this entry before: debit purchases, debit freight in, credit accounts payable. Right? So this is periodic, right? Periodic inventory system. We know that because we're using that purchases account. With the perpetual inventory system, we do not use that purchases account, right? Okay, so on August 8th, issued check number 2076 to Pataponia Inc. in payment of invoice 2706 less the cash discount. So again, my favorite way to do this, because how much of a discount? 2% off, right? We see that here, 2% off, right? So my favorite way, just like I showed you guys in class, 17.95 times 0.98, or in other words, 98%. We only have to pay 98% of this invoice, right? And so that's where we get our cash amount that we're going to have to pay, 1,761.30. Right. Okay. Not too bad, I think. Anyway, we've already got some practice with it together, so we'll get some more practice in class. Okay, and now it's just showing us and highlighting again this purchases section. I've already talked about it a little bit a few slides ago, but we take our total purchases, and that's that 87,840. And then we subtract or less purchase returns and allowances. So we're minusing or subtracting 2,280, and that gives us that those net purchases, 85,560, right? And then if we add freight in, then that's how much it cost us to deliver all the purchases, right? That's the delivered, or how much it costs for us to have the purchases delivered, rather. So that, that cost is added into the delivered cost of purchases. And that's what they're showing us here, delivered cost of purchases. Okay. All right, so trade discounts. So trade discounts we haven't talked about yet. Trade discounts are discounts that are given usually maybe for, different things related to, volume, for example, things like that, volume discounts, things like that. And so usually these are off the top, where it's like a 40% trade discount or 30% trade discount. So it gets just recorded like a normal sale less the discount. We don't actually record a discount on this one. So that's what it's telling us. It says reductions from the list prices. Manufacturers and wholesalers publish catalogs listing their products at retail prices. But again, when purchasing in volume, for example, they offer discounts, not journalized because they are not related to cash payments. Help avoid the high cost of reprinting catalogs when selling prices change. Single percentage versus chain of percentages. So this example is showing us a single percentage example. So it says firms may quote trade discounts as a single percentage. For example, a distributor of furnaces grants a single discount of 40% off the listed catalog price of $8,000. So if we take that 8,000 times 40%, the actual selling price then is 4,800. So you'll see it's recorded just as, just without the discount. Basically, we're not recording a discount. It's recorded. There's the debit to accounts receivable. There is the credit to sales revenue, right? And just like it shows us here, neither the seller nor the buyer records trade discounts in the accounts. They enter only the selling price. So this would be from the seller's perspective, right? And then this down here would be from the buyer's perspective. Okay. Okay, so the cash receipts journal. So the purpose of the cash receipts journal is basically if we have several, excuse me, if we have several ins and outs and several cash receipts during the day, different transactions of impacting cash, what we might do is keep a cash receipts journal that we can record each transaction in. And then at the end of the day or the end of the week or the end of the month, whatever the case may be, then we take that amount and we transfer that one amount to the ledger account. So it saves us from putting multiple cash receipt transactions, into the cash main general ledger account. Because what we do is, again, we record them in the cash receipts journal, and then we take those aggregate or those total amounts from the cash receipts journal and journalize them, or post them rather, to the ledger accounts, right? And so what it's telling us here, cash receipts journals contain all transactions in which cash is received or increased. When a cash receipts journal is used, all transactions in which cash is debited must be recorded. So in all transactions where cash is going up, where cash would be debited, must be recorded in it. May be used for a service as well as a merchandising business. So the next slide is going to show us an example of this. And so it's got several different transactions. For example, on this one, it looks like this was an accounts receivable collection. Here we had the debit to cash. And then here we're going to have the credit to accounts receivable, right? So that one was an accounts receivable transaction. It looks like this next one is the owner making an investment, right? So that was this one. Now this next one, the 7th, is like the owner making an investment, because you can see here the debit to cash, and then the $9,000 other credit, that would be to, owner's capital or whatever, right? That's D. Bruce Capital. Let's see, I'm not going to go through every line of these, but again, we can see, let's look at one that's a sales credit. So this 2460 right here, 2460. So this one was a debit to cash, credit to sales. So that was a cash sale. So also, where is one where we can see this is a payment, like this one right here. This is a payment. So guides, trying to like write as good as I can or circle as good as I can. But this is a payment and we can tell because again, cash is going up. You know, customer paid us, basically cash is going up. There's the debit to sales discount, and then there's the credit to accounts receivable. So anyway, several different transactions impacting cash. So instead of recording all these individual transactions in the cash ledger account, the main general ledger account, we get the aggregate total down here, right? We get the aggregate total, and that is what matches. I thought I had, well, that's okay. We get the aggregate total, and then that total just gets recorded in the cash account. Right? So we use the cash receipts journal to record all of these, you know, smaller, I guess, type transactions, and these multiple cash inflow transactions. And then when we actually do the journal entry, we do the journal entry to just record the aggregate amount into that cash ledger account. And same thing for the rest of these, right? We've got where's this? Oh, credit card expense, $20. That's matching down here, right? And then we've got what, sales discounts, right? And that's matching our sales. So we're just recording them in the T accounts, you know, the aggregate amounts. And so this is really only used in a, you know, an accounting system in which we're still using paper documents and paper ledgers and things like that. Otherwise, accounting software has kind of these features built into it, right? Okay. All right, advantages of using a cash receipts journal. Transactions can be recorded on one line. All transactions involving debits to cash are recorded in one place. Eliminates much repetition in posting to the general ledger when there are numerous transactions involving cash debits. Special columns can be used for similar transactions and posted as one total. All right, the cash payments journal, similar to the cash receipts journal, is a special journal used to record all transactions in which cash goes out or decreases. When the cash payments journal is used, all transactions in which cash is credited must be recorded. May be used for either a service or merchandising business. So same thing with the cash receipts journal, right? So here's an example of that. And again, you know, these are individual transactions. It looks like this first one to Pataponia, if we look at the accounts that it's impacting, we've got a debit to it. So we're making a payment to Pataponia. We got a debit to accounts payable, credit to purchase discounts, credit to cash. So we made a payment to Pataponia, right? This one, it looks like we paid wages. So it says other accounts debit. And so that's a debit to wages payable, credit to cash, right? Let's see here. Ooh, this one. This one we made a purchase. So debit purchases account, credit cash. This one we paid freight. So debit freight in, credit cash type deal, right? So we accumulate them, you know, in this case for the entire month, right? We're looking at the month of October. So we accumulate all the transactions for the entire month. And then at the end of the month, we record the aggregate amount. These are the amounts we record at the end of the month. Okay. All right, so excuse me, some of the advantages of using the cash payments journal. Transactions can be recorded on one line. All transactions involving credits to cash are recorded in one place. For numerous transactions involving cash credits, the cash credit side can be posted in the general ledger as one total, and special columns can be used for similar transactions and posted as one total. So again, we're just aggregating the totals. Instead of posting and journalizing and doing a bunch of entries to the general journal, we're just doing an entry for the more aggregated or aggregate amounts. Okay, so let me blow this up a little bit. So this just talks about these special journals, right? Using these special journals and some of the types of transactions that we would use these for. And so we've got some different sales journals, and this was touched on a little bit at the end of chapter 9, but for the sale of merchandise on account, that's our sales journal. Oh, I guess because I'm that's interesting. I guess because I have it blown up a little bit, it's not writing, it's pulling it up and down. But anyway, so on the sale of merchandise on account, that's our sales journal we use. For the purchase of merchandise on account, that's our purchases journal that we use. For the receipt of cash, we just talked about, for the receipt of cash, we use that cash receipts journal. For the payment of cash, again, that cash payments journal, right? And then miscellaneous stuff, entries posted daily to the subsidiary ledgers and the general ledger, right? So, you know, each journal, which each one goes with, and the different ones that we talked about. And I guess, yeah, because we looked at these in, let's see, I think they showed us these in chapter 9. And so now we just talked about these in, in chapter 10, right? Okay. All right, here are some of the exercises that we're going to do in class together. And so I look forward to getting practice with these. I know, like I said, that we were already able, luckily, to get some practice with them together in class and to talk about it a little bit together in class, but we'll get some more practice with it. And as always, if you guys have any questions, just let me know and I'll see you in class. Bye-bye.